Hello, I'm Russ Mould, AJ Bell's Investment Director, and welcome to Fundamentals, where I'm going to look at one of the most popular funds on the AJ Bell Invest Centre platform right now, namely Old Mutual North American. The £1.2 billion collective's mandate is capital growth. It'll seek to provide this, as the name suggests, by putting money to work in US or Canadian quoted companies, although it can also invest in other funds, warrants, money market instruments, and also derivatives. Old Mutual North American's benchmark index is technically the MSCI North American one, whose performance over the past 5 years is shown here. Although the fund pays scant regard to the index and has no desire to be seen as or act as a closet tracker. What makes this fund particularly interesting is it is a so-called quant fund, where the stocks are not picked by fund managers but computer models designed to screen for certain characteristics, a process known as quantitative analysis. In this case, Old Mutual North American will screen stocks by valuation, balance sheet quality, growth, return on capital, and a number of other factors including market sentiment and prevailing trend momentum. The net result of all that is a very diversified portfolio with 245 holdings, the top 10 of which represent just under a fifth of the portfolio. The top 5 positions, well, they're all very well-known names: Apple, Amazon, Alphabet, Intel, and Cisco. By sector, technology's got the biggest weighting at just under a quarter of the assets under management, and it's followed by financial services and healthcare, as we can see here. The product comes with an ongoing charge figure of 1%, so it may not be the cheapest, but the results have been good. Old Mutual ranks 3rd out of a 24-strong peer group in terms of 5-year performance. The yield is just 0.5%, but then income isn't the key goal. And for those who place store in such things, the fund gets a 5-star ranking from Morningstar. So those are the mechanics. The question is, why would advisors and clients potentially be buying this fund now? And I think there are, well, 3 potential reasons. First, advisors and clients might like the dispassionate quantitative approach that looks to tackle the issue of fund manager, human, error. The fund ranks top 4 against its peers on a 1, 3, 5 and 10-year view, even if America's been a horribly difficult market to outperform. Second, Old Mutual North American brings exposure to tech and healthcare, sectors that aren't easy to access through the UK market in particular. Now, some advisors and clients may blanch at the valuations afforded to Apple, Amazon and Alphabet, but the share prices have been running strongly of late, and this growth exposure is a potential attraction. And third, any advisors and clients potentially buying the fund may get the dollar on their side. The US currency is nudging higher against the pound as markets look toward a US Federal Reserve interest rate hike in December, which may or may not happen, while the Bank of England is still for sure running its additional quantitative easing scheme. Now, there are risks beside those 3 potential attractions. No one knows how the US presidential election will play out in November as Donald Trump takes on Hillary Clinton. In addition, it's easy to argue that US stocks are expensive relative to their history, using metrics that don't rely on habitually optimistic near-term earnings forecasts from analysts. A better one may be market cap to GDP. As we can see here, it doesn't make the US market look so cheap. In addition, the US stock market does tend to do less well when interest rates are rising, at least relative to when they're falling. So a Federal Reserve hike on the 2nd of November or 14th of December could provoke some volatility. This chart shows what happened to America's S&P 500 in the 3 months before and 3 months after last December's quarter-point increase. As a result, it may be worth checking that the US equity market fits with the client's overall strategy, target returns, time horizon and tolerance for risk, no matter how tempted they may be to seek overseas exposure given the current uncertain situation here in the UK. So thank you for watching, and I look forward to seeing you next time.